Today we're going to go over how to answer a super hard technical accounting question. So I want to just dive right into the question because I don't want to go over 10 minutes. So the question is here. GM raises a $100 million note to buy a $100 million plant at the start of the year. Amortization is 15%, interest is 5% cash, 7% PIK, and all of this is payable at the end of the year. The plant is sold at the end of the year for $120 million. Please walk through what happens at the start of the year and what happens at the end of the year. So several key things to note is anything you don't understand, please ask about it. So clarify items that you don't understand. And here I see two things. One is amortization of debt, and another one is PIK. So amortization here does not refer to the depreciation of intangible assets. That's something completely different. This is talking about amortization of debt. So it's basically wherein you have a loan where the principal of the loan is paid down over the life of the loan, not only at the end of the maturity date. The second is PIK. PIK, you can basically think of it as deferring your interest payments until the maturity date. So it's sort of, I like to think of it as the opposite of amortization. And you can think of it that way as well if that helps. So typically when you're in this type of interview, you want to structure your thoughts very logically. So going back to the question, what it's asking you what happens at the start of the year and what happens at the end of the year. So let's put down start of the year and the end of the year. You want to have a clean split between your three financial statements as well, so that it's easier for you to track the changes and what happens with each line item. So we always want to go with the income statement first, and that's because the final line flows into the cash flow statement, and the next one is the cash flow statement, and the final line there flows into the balance sheet. So that's sort of the logic of why you want to keep a clean division of these financial statements. So do the same for the start of the year at the end of the year, and let's start the process at the start of the year. So first of all, nothing happens in the income statement at the start of the year because all the tough changes happen at the end of the year. However, in the cash flow statement, there will be certain changes. So there'll be changes in your cash flow from investing and your cash flow from financing. In your cash flow from investing, you get an outflow of 100 million. That's from the PP&E, and you get in your CFF you get an inflow of 100, and that's from the loan. So net would be 0. In your balance sheet, your PPE is affected and your debt is affected. So PPE up by 100 and your debt is up by 100. And the fundamental equation, assets equals liabilities plus shareholders' equity, that balances. So we're good on the start of the year. At the end of the year, this is where things get tricky. So first you want to put a gain on sale of 20. And this is from the asset that you sold. Then if you go back, you see that interest is 5% cash and 7% PIK. So you have to add both of those. 5 plus 7 is 12. And that's the interest expense that you get, 12. Because the total amount of the debt is 100. So gain on sale of 20 and interest expense of 12. This ends up being a net, your pre-tax income goes up by 8, and if you apply a tax rate of 40%, that gets you up by 4.8. So this would be the first line in your cash flow statement. It's up 4.8 from your operations, and also in operations you have to add back the PIK interest of 7, and this is because, as I mentioned a while ago, PIK payments are basically deferred until the end, until the debt expires. So there's no need for any real cash outflow right now. Then in your CFO2, you want to subtract the gain of 20 from the sale, and in your CFI, you want to add sale proceeds of 120, and your CFF cash outflow of 15 from the amortization of debt. And when you add all of these together, your net cash is up by 96.8. This cash balance goes to your cash account in your balance sheet. So your cash is up by 96.8. Also on the assets, PPE down by 100. So in total, you get 100 minus 96.8 on the assets. Assets is 3.2 up, sorry, 3.2 down. And when you look at your liabilities, your debt is down by 8. So you get negative 8 because we're subtracting the 15% by the 7, which is the interest that you get from the PIK, which is deferred. So 15 minus 7 is 8. And in your retained earnings account, you get your last line in your income statement, which is 4.8. So when you add all of this together, you get liabilities plus shareholders' equity. So 4.8 minus 8 equals negative 3.2. So just check that these two items balance, and they do. So you know this answer is correct. So this is a question that's a bit tricky, and I also have a hard time going through this. A few key takeaways is write the question down, especially if it's long and hard. Keep track of all the moving pieces. Take your time, but don't take too long either. And practice at home and experiment with various cases. Thank you, and if you have any questions or any comments, please let us know and we'll do our best to explain it.